Have you ever felt this? Your business, it's buzzing. Sales are climbing, everyone's working flat out, but, well, the bottom line just isn't keeping pace. Maybe it's even shrinking a bit.
Yeah, it feels like you're running harder and harder, but somehow not really getting ahead.
Exactly.
Yeah.
And it turns out this isn't just, a feeling, it's a real thing.
It is. There's actually a term for it, flagged by the ITR Quarterly Economics Report. They call it profitless prosperity.
Profitless prosperity. Huh. Sounds like a complete contradiction, doesn't it?
It does on the surface.
How can you have prosperity, like growing revenue, but no profit growth?
Yeah.
Or even less profit?
That's the paradox right there. Profitless prosperity is exactly that. Your top line, the total money coming in, is going up, but your actual net profit, what's left at the end of the day, is flat or even falling. It really goes against that old idea that, more growth always equals more success.
So what's behind this? Why is this happening now? It feels urgent.
Well, it's not just one thing. It's more like a perfect storm. Costs are rising pretty much everywhere. Think about labor, materials coming in, imports, the cost of borrowing capital, energy costs. They're all squeezing margins. And then layer on top of that this huge surge in demand for things like AI infrastructure and automation.
Right, which costs money up front.
Exactly. Big investments. So if companies are just chasing that top-line revenue number, just trying to sell more, without really watching these rising costs and protecting their margins?
They end up running faster just to stand still? Or worse?
Precisely. Profitless prosperity.
And I think you mentioned some businesses are more at risk here.
Yeah, absolutely. We're seeing mid-market companies hit particularly hard.
So maybe generating, what, $10 million or $100 million in revenue?
That's the range, generally. See, they're big enough to have real complexity in their operations.
Right.
But they often don't have the really deep profit margin or maybe the super tight operational discipline that, huge corporations have built up.
They don't have that wiggle room.
Not as much, no.
Yeah.
They can't afford inefficiency in the same way.
Okay, this makes this deep dive really critical then. So our goal today for everyone listening is to really get under the hood of this profitless prosperity. Understand it.
And more importantly, figure out what you can actually do about it. We want to share some concrete strategic actions you can take.
Right. Not just to dodge this trap, but to actually build real, lasting value in your business.
Because we've got to remember, just growing sales isn't the same as growing value.
Good point.
If you're only focused on that top line and not what you keep, you can end up on this treadmill burning energy, but not actually building wealth or stability.
So let's get off the treadmill. We've outlined 5 key strategic actions to help you avoid this whole profitless situation and build that real value. Yeah. First up, being proactive with strategic planning.
Yeah, this is crucial. The old model, where you set a strategy once a year and kind of just let it run.
Put it on the shelf.
Exactly. That just doesn't cut it anymore. Things change too fast.
So what's the alternative?
You need a more dynamic rhythm. Think quarterly, a regular discipline check-in.
Okay, like a quarterly strategy review.
Yes. Looking at the financials, assessing the risks that have popped up, maybe recalibrating priorities based on what's actually happening.
Makes sense. It's like you wouldn't navigate a ship across the ocean by only checking the compass once a year.
Great analogy. Imagine you catch a, say, 2% rise in a key material cost after just 3 months. In that quarterly review, you see it, you react.
You can maybe renegotiate or look for alternatives.
Right. Instead of finding out a year later that it's eaten like 10% of your profit margin, that's the proactive difference. It has to be a leadership discipline, not just a once-a-year event.
That really shifts the perspective. But practically speaking, how do you build that quarterly rhythm without it just feeling like more meetings, more overwhelm?
It's about focus, not necessarily more time. Maybe it's a dedicated half day each quarter. Just the leadership team.
Yeah.
And you're not getting lost in the day-to-day weeds.
Stepping back.
Exactly. Seeing the bigger picture, making those course corrections based on real data, making sure everyone's still pulling in the same direction.
Okay, so you've got this proactive planning rhythm going. What's next? Our second strategic action focuses inward, right? On profitability itself.
Yes. You need to pay really close attention to profitability. This is where companies often stumble, I think.
I hope so.
They chase revenue, any revenue, instead of focusing on profitable revenue.
The distinction is key.
It absolutely is. Because it's the profitable revenue that ultimately drives the value of your business. You've got to get granular here.
Meaning?
Meaning understand the profitability of each part of your business, each division, each product line. maybe even down to key customer segments.
Wow, that detailed.
It can be revealing. I worked with a business once. They did this analysis, found out 20% of their customers were actually losing them money.
Seriously, how?
High service demands, always asking for discounts, ordering low margin stuff. It all added up, especially when costs are rising, like now with inflation or supply chain issues.
Right.
It's so easy for those increased costs to just sneak past old pricing or inefficient operations if you're not looking close.
So you need that precision in your numbers.
Precision and accountability. You know, Peter Drucker's famous line, "What gets measured gets managed." It's absolutely true here.
Love that quote. It really changes the focus from just sell more to sell better, more profitably. Which leads nicely into our third action,
Yeah.
really leaning into your competitive advantage.
Yes, because if you're aiming for profitable revenue, you need something that allows you to command it.
Something that makes you different.
Exactly. You need to double down on what makes your company unique and valuable. What is it that sets you apart? Is it an amazing customer experience? Some kind of proprietary technology or process? Maybe deep expertise in a specific niche?
That's your edge.
That's your edge, your moat, you could call it. That's what protects your margins when everyone else is competing just on price.
Which feels like a race to the bottom.
It is a race to the bottom. And that's a highway to profitless prosperity. Your moat, your competitive advantage, lets you justify better pricing, keeps customers loyal, even when things get tough.
So you need to identify it, build your strategy around it.
Communicate it clearly to your team, to the market, and protect it fiercely.
Okay, building the moat is vital. And increasingly, technology plays a part in that, doesn't it? That brings us to action 4. Using tech for operational efficiency.
Oh, absolutely. Technology, especially things like AI and automation tools, is a massive lever right now.
In what ways?
We're seeing huge efficiency gains across almost every function. Customer service chatbots, AI for sales forecasting, optimizing logistics, streamlining finance. The applications are everywhere.
But there's a risk of just chasing the latest tech trend, right? The shiny object syndrome.
Totally. That's the caution here. Don't just buy tech for tech's sake. Focus on practical investments, tools that genuinely streamline how you work, cut down on manual tasks, and importantly,
Free up your people.
yes, free up your team to do the higher value, strategic thinking, customer-facing work that technology can't do.
You give an example.
Sure, I know a mid-market manufacturer, they brought in a relatively simple AI tool just for inventory forecasting. Nothing super flashy. Within 6 months, they cut their excess inventory by 20%. That freed up a significant amount of cash that was just sitting there, tied up on shelves.
Wow. So efficiency isn't just about cutting costs.
No, it's about creating capacity. More capacity for work that actually adds value.
Makes sense. And that leads us to the final strategic action, number 5, developing a solid pricing strategy. This seems like one that could easily get overlooked or become purely reactive.
You hit the nail on the head. So many businesses treat pricing like something you set once and forget, or maybe you just tweak it when your supplier raises their prices.
Reacting, basically.
Exactly. In this kind of environment, you need a proactive pricing strategy.
What does that involve?
It means really, truly understanding the value you provide to your customers, staying constantly tuned in to what's happening in the market, and critically, training your sales team
Training them how?
to sell based on the outcomes and the value you deliver, not just defaulting to discounts to close a deal.
Because every discount eats into that precious margin.
Directly. If your team's go-to move is cutting the price, you're basically funding your profitless prosperity from the inside out. Pricing isn't just a number, it's a strategic function. Handled well, it's a huge driver of profitable growth.
These 5 actions, they all seem to point towards a bigger picture, beyond just day-to-day profits. You mentioned valuation earlier.
Yes, let's talk about that, because ultimately this whole conversation circles back to a fundamental truth. Your business's valuation is the real scoreboard.
The ultimate measure.
I believe so. Look, companies just chasing revenue, they're playing a risky game. Those managing to protect profit margins, better. Definitely better.
But still maybe not maximizing.
Right. The real winners, the businesses that create true freedom and options for their owners, are the ones who understand how to build not just profits, but the quality of those profits.
Okay, quality of profits. What does that mean exactly?
Yeah.
It's not just the amount.
It's more than just the amount. So when you value a business, yes, the quantity of profit matters, your EBITDA. Earnings before interest, taxes, depreciation, amortization, that number is important.
That's the how much?
That's the how much. But the quality piece is what determines your multiple, how many times that EBITDA a buyer is willing to pay.
And what defines quality?
It's things like, how strong are your systems, your processes? Do you have a great team, a recognized brand, a loyal, diversified customer base? Things that make the profit stream reliable and likely to continue or even grow.
So valuation isn't just about last year's earnings.
Not at all. It's about the confidence someone else has in your ability to sustain and grow those earnings in the future. That's quality.
That's a powerful way to look at it, which raises a question. If valuation is so crucial, this ultimate scoreboard, do most business owners actually know their score?
Well, the data suggests probably not.
Really?
Yeah, the ITR report had a pretty startling statistic on this. Less than 40% of mid-market business owners have actually had a formal valuation done in the last 3 years.
Wow, less than 40%. That means the majority.
Are essentially flying blind when it comes to understanding the value of potentially their biggest asset.
That seems like a huge blind spot, especially if we're trying to avoid profitless prosperity and build real wealth.
It really is. Think about it. Knowing your valuation gives you that baseline. It immediately highlights where the gaps might be.
Where you can improve systems or people or processes.
Exactly. And then you can set really intentional strategies, not just to boost your EBITDA, that quantity piece, but also to improve those quality factors that drive up your multiple.
And when you increase both,
That's where you can unlock truly exponential growth in value. It's powerful stuff.
so it really feels like we're shifting the definition of growth here. It's not just about getting bigger in terms of sales.
Precisely. This leads us to what I think is the key takeaway. Value creation is the new growth strategy.
Value creation is the new growth strategy. Say more about that.
It means focusing on growth that is profitable, yes, but also sustainable over the long term and critically transferable. Meaning, the value isn't just tied to the current owner, it's embedded in the business itself.
That transferable piece is huge for legacy, for options down the road.
Absolutely, because when you shift your focus from just chasing the next sale to deliberately building this kind of underlying transferable value, you gain something more powerful than just money.
What's that?
You gain options, you gain freedom, you build a real legacy. That's the real payoff.
And the encouraging part is this profitless prosperity isn't inevitable. It's not a risk you just have to accept.
Not at all. There's a clear path away from it by being intentional, by implementing these kinds of strategies we've discussed today.
Proactive planning, focusing on profitable revenue, leveraging your unique advantage, using tech wisely, smart pricing.
Exactly. You can absolutely chart a course towards true, profitable prosperity. You can build undeniable value and really grow your impact, not just your revenue figure.
What a fantastic deep dive. We've really unpacked this idea of profitless prosperity, this counterintuitive trap.
And hopefully armed you with those 5 concrete strategies to build genuine, sustainable value instead.
Quick recap. Be proactive in planning, get laser focused on profitable revenue, lean into what makes you unique, use tech smartly for efficiency, and develop that proactive pricing strategy.
And remember, valuation is that ultimate scoreboard. It's driven by both the quantity and the quality of your earnings. Knowing your number gives you clarity and power.
So let's leave you with this thought to chew on. If valuation truly is the ultimate scoreboard for your business, what hidden strengths or maybe what hidden weaknesses might you uncover if you started looking at your business through that valuation lens today? And thinking bigger picture, what kind of legacy do you really want to build with it?